Hello everybody. So this is a very quick video today, but a common thing that I hear often is, oh, I missed out on that growth stock. I'm too late. I bought it too late. The stock has run up and it's now too late. And I want to just illustrate this quote of the "I missed out" quote with Tesla, right? So if you look at Tesla, Tesla has been trading for 13 years. And so Tesla, of course, did nothing for like a year and a half. Then it did a 10x. Then it did nothing for 6 years or 7 years. And then it did another 10x. So 10x by 10x, that's 100x. And today we have been between 300x and 161x compared to the IPO price. So right now, as of today, the return you would have done is a 16,100% return. Insane returns. And so it's easy to think, if you're buying Tesla around here, it's easy to think that you've entirely missed out. But if you were buying around here right after the first 10x, right, if you were buying in late 2013, it would have been easy to think that you had missed out also for you. And this is, I think, one of the key distinctions is that we have to look at stocks over time and at valuation of these stocks compared to their fundamentals over time. So let me just explain really quickly, and today is a quick video. But investing is not speculating. It's not like you're buying tulips or a comic book, right? You're buying an underlying assets with actual fundamentals, and actual fundamentals that improve over time. At a fundamental level, what happens is that Mr. Market applies a ratio. It applies a ratio between the price of that company and some fundamental metric. And for growth stocks, that fundamental metric that Mr. Market uses to give you a stock price is, I believe, the price to sales ratio. It's one of the most widely used metrics and one of the better ways, I believe, to assess a growth stock and whether a growth stock is overvalued or undervalued. Now, I actually prefer price to gross profit ratio, which is why in my most undervalued stock video, I typically use price to gross profit, but that's a topic for another video why I prefer price to gross profit over price to sales. I think what the market uses with price to sell is relevant enough for us, and as far as we're concerned, it's relevant enough to know whether you're actually overpaying for a stock or not. You have to look at the price. I believe the price of a stock has to be looked at in relation to its most fundamental metric for growth stock, which is revenue. How much revenue does that stock have? And let's go back to my example of a comic book. So if you were buying comic books hoping the comic book goes up in value, and the comic book does 100x or 200x, then by all means you gotta sell that comic book, in my view, because the comic book has not changed in 13 years. In fact, it got older, but it hasn't changed that much, right? The product is roughly the same 13 years ago as it is today. So if you had a crazy increase in price like that, you could make a really strong case that it needs to be sold, unless you believe in things like greater fool's theory and that someone is going to be out there wanting to pay more than you paid for it 13 years ago. But a business is different, right? A growth stock, a business, is about riding a megatrend. You're riding a very, very long-term megatrend of disruption most often, at least for the stocks that I cover in the channel. And because those businesses that you invest, that business, in the case of Tesla, that you would have bought in 2010, it's been riding that megatrend for 13 years. So the business has changed tremendously in 13 years. In the case of Tesla, you have 100,000 people right now that are working really, really hard to make their vision happen, right? And to grow the business. You're buying an underlying asset that is changing. That's why looking just at the stock price is really irrelevant when you don't look at it in relation to fundamentals of the business. And sales don't lie. Sales are the one metric that can't lie to you, doesn't lie to you, right? Sales go up. That means that the customer likes the product. That means that the product resonates with the customer and the customer goes and buys the product. So when you look at this chart right here, really stunning chart of growth, the best performing investment of the past 10 years. What do you think happened in the same time to the Tesla sales, right? And that would be a way for us to know whether it's speculation or not. What happened in the same time to the Tesla sales? Well, here it is. here is the chart, right? So Tesla sales, when Tesla IPO'd, they had $90 million in sales. Today, they have $82 billion in sales. So what we can say about the sales, that the sales of Tesla over that 13-year period grew 900 times, more than 900 times. Did that comic book grow 900 times? Do you have 900 comic book today if you were to talk about speculation, right? So the size of the business has grown 900-fold, and the valuation actually has grown between 300 and 150-fold. So you could almost make an argument that Tesla's stock has not run up enough. And actually, I believe that Tesla is undervalued, heavily undervalued, because they're still growing at 50% from a base of $82 billion. So what I want to do for the remainder of the video, and it's going to be very quick, is look at the price to sales ratio, i.e. the price right here, this chart, this graph, divided by revenue over time. This graph, that's price right here, divided by sales, and look at that ratio, and look at what the ratio Mr. Market applies. And as long as the ratio that you're paying in the early days of the stock right here is not too vastly different from the ratio that you're paying, say, 10 years later from the stock, you really can't make the case that that stock is more expensive. You really can't say that, because the business's fundamentals have improved tremendously in line with the improvement in the stock price. So if you look at Tesla, this is the blue line right here. My chart, when I look at the data, unfortunately, it only goes back to Q1 of 2021, but I recalculated at IPO, and Tesla traded at IPO at about 24 times sales when it IPO'd in 2010, in mid-2010. They traded at about 24 times sales. You can see, so IPO always goes with a very high valuation. Typically, you often have a crash or a downturn after an IPO. We all know that now because of 2021. I mean, it's always been known that buying an IPO is a bad idea. But you see a drop in price, and then it goes up, and then it fluctuates. But you see that Tesla has been fluctuating between, say, 5-ish, 4-ish times sales and 25-ish times sales. That's what they fluctuated at. And, you know, over time, like even if you buy at the peak in 2012, over time, that growth, those 50% revenue growth that Tesla has had every single year for years and is predicted to continue having, over time, that will trump even overpaying, say, in 2012. But if you look at the valuation, you can see that today, you're buying Tesla at about 5 times sales, which is historically pretty low. It's a pretty valuation historically compared to where Tesla has been. You can see that Enphase, you're not buying as low compared to the historic pricing of Enphase. So what I want to do for the remainder of the video is just go through each of my stocks in the most undervalued stock universe, is what I call my coverage universe, and just show you that chart over time. And feel free to pause for each of these and see whether right now the price to sales, this is price to sell, whether that price to sales you think is a good price or not. So this is Tesla and Enphase. You can see we've had a drop in price to sales. It's now cheaper, the cheapest in the past 2 years that you can buy both Tesla and Enphase. You know, going on with HIMS and Teladoc. So Teladoc and HIMS, both, it's the cheapest in the history of both of these companies that you can buy the stock. The cheapest in history. It's never been trading that cheap. If you look at all of my data warehouses and data SaaS stocks, same. They are right now on a price to sales basis trading at the cheapest in their own trading history. If I go on and if I look at cybersecurity stock, we see that we are now back at very inexpensive trading prices that we had in the 2020s. Cloudflare actually you could have gotten cheaper back in 2019, but aside from Cloudflare, it's about the same. So again, very low pricing right now. Moving on, so Mercado Libre and Shopify, which are the 2 stocks on the channel, and I'm about to cover Coupang and C Limited, which is why I added this. Same, these e-commerce stocks, you can buy them the cheapest they've ever traded at, right? Growth is like, Mr. Market is really dumping growth, giving no value to growth on a price to sales basis right now, even though it still looks like those stocks have run up 100x, 50x over a 10-year period. It still looks like that, but on a price to sales basis, Mr. Market is not giving any valuation. Same for payment companies. Look at these payments companies, all relative to where they were traded. They are now trading at lower price to sales ratio. Again, feel free to stop. Not true for the chip stocks. The chip stocks are actually still trading fairly more expensive compared to what they've traded in the past, right? Interesting to know that. But if you look at the past few quarters, they are actually trading just a tad lower, but not that much compared to a lot of the other stocks. And why do we have that for the chip stocks and AMD and NVIDIA? We have that because their revenue growth has come to a stop. So if your revenue growth, if your sales growth comes to a stop, that valuation here is going to go up if the stock does not draw down at the same pace that the revenue draws down or goes down. PubMatic and Trade Desk, they are trading pretty cheaply, both of them compared to their historic levels. In the case of Trade Desk, we've gone back to the 2019 levels. So again, fairly good price. I couldn't get the chart to show for Nubank, so I can't comment on Nubank, but SoFi, I can comment on SoFi, and SoFi is trading the cheapest it's ever been. This is the cheapest you can buy SoFi on a price to sales basis, right? And lastly, with platforms are the same way. A platform like Fiverr or Etsy went back to the way they were trading in Q1 of 2020. And Airbnb, it's just about the cheapest on a price sales basis that you can buy Airbnb. So the market in general, when you use the price to sales ratio, and if you look back over time and the length of trading that they had, these stocks right now are very, very inexpensive. Similar to what I found out in my most undervalued stock video. So it's a wonderful time to buy growth stocks. I'm kind of sad that we're getting out of this cheap pricing era because I believe the Fed's going to pivot. But I believe right now I'm buying stocks right now. This is not investment advice, never been investment advice. This is just entertainment. Thank you for liking, thank you for subscribing, and have a great day.